What's up, outliers? Happy Friday. Today, I am kicking off yet another mini series. So, the reason for this is the Greeks mini series is probably going to take us, I'm guessing, around 6 weeks, like 6 episodes, one episode every Friday. And I don't want it to be disrupted. So I'm purposely finding a block of time where that one can go through and we can find ourselves uninterrupted, able to go through all of the Greeks in detail. So that'll probably kick off, I'm guessing, in September. Now, bringing us into September, I actually went through and built several miniseries. So it's kind of like 1-2 episodes each. This one is a 2-episode miniseries. And the topic is trying to conceptualize fixing your options trading, really fixing your trading in general. This is not really limited to options traders, although it's definitely done in the context of options traders. So my intent for this episode is I want to start with the diagnostic process, trying to look at what we're doing and figuring out what is working, what is not working, essentially taking our temperature, seeing what things are current state. And then the next episode, we'll take a look at some of the outputs from the diagnostics and look at practical methods to fix or adjust fire on what we're doing. So I want to start us from this concept of, as per usual, the way most people trade options. The reason why I think that this is super important is because it gives us a complete level playing field. So you already know where we are going in order to get this context. You guessed it, fan favorite. We're going to go to Reddit. And Reddit continues to be one of my absolute favorite proxies for the average retail trader. And it's because it probably is quite representative for the average retail trader. So now we'll spend a couple moments talking about what the average person is doing. None of this is going to stick out to most of us, but I want to highlight a couple key themes that we come across and then discuss ways and different impacts that those ways of thinking can have on our performance. In the meantime, as we go through this, if you have any specific hurdle that you are attempting to overcome with respect to trading, please throw it in the chat, because we can take time to look at that together and something hopefully that's made relevant to you if that circumstance exists. Lauren says, I never go on Reddit. Apparently I'm missing out. I actually don't think so. The main reason is sometimes there can be gold on Reddit. That's for sure. But the reason why I use Reddit as a proxy is actually not a good thing. It's a good thing from my end, from like a research perspective, right? Because think of it this way, without this spot, if I wanted to understand the general sentiment of a standard retail options trader, I can't get it. There's nowhere for me to get that data. So this is good, really good from a research perspective, because it gives us like a true qualitative look at how most people are going to trade options. Now, the one thing I will add on top of this, though, is that Reddit actually, in my opinion, increases the threshold ever so slightly for the sample that we're looking at. There's a lot of options traders that will just sling options, definitely don't care to post about it, and they'll just lose their money that way. I think the people that you'll find on Reddit are a different cohort. I think you find people that are at least interested enough that they're willing to make a post about it. Not so interested, most of the posts are pretty low quality. So it gives us a really good glimpse into the general mindset and methodology. And as always, the reason why that's important is because when we're trying to figure out as traders what works, what doesn't work, what to do, what not to do, a lot of the best data points that you can get are not just what to do, but also what not to do. So the way I'm going to approach this is I'm actually going to flip through this and use it for information for our conversation today. I'm going to use it actually for context for us to work through some of these more common behavioral / process issues that plague traders. Now, notice how I started with those two buckets. That's an important element. So if I am coaching myself and I'm pretending that I'm talking to Eric that was trading maybe 2 years, because in the first year, there's not really a whole lot to talk about. 2 years, I think there's enough context for a good conversation to be had for somebody that's still very new. If I were to have that conversation with myself and be trying to help myself take a look at what I'm doing and try and improve it, there's a couple places that really start the conversation. The first one is knowledge. Next is process. Next is behavior. I don't know why I started that with a D. That was ridiculous. So this way, you guys see me do this literally over hours and hours and hours of streams at this point. I always try to bucket and categorize things so that we can pull as much information from it as humanly possible. This bucketing process is super, super useful. Again, this is really a consulting thing, but I'm calling that out because it's a behavior you all should work on developing. As you're looking at your own stuff, you should try to think, are there big buckets that I can group things into logically that might help me identify themes more effectively? Now, for the trader that's been trading, again, less than 5 years, I always consider that a beginner trader. And you're less than 5 years into your path. These are the three main areas that you need a lot of work in. And the cool part is this first one really has become easier than ever in terms of access to decent information. This really isn't a thing in terms of being a big roadblock. This becomes a roadblock primarily in the context of not knowing what you don't know, overconfidence, a less common but equally important one realistically is underconfidence. Funny enough, I actually think personally, within our trading community, this is the bigger problem than this, which I argue is a high-class problem. I think that's a good thing. I think it's a better thing to be slightly underconfident than overconfident, because overconfidence essentially will lead to blowing up. And underconfidence leads to slow decision-making and not pulling the fucking trigger. So the reason why I'm building these out with you right now is because I guarantee it, when we scroll through our options subreddit together in a few moments, I guarantee you that you are going to find artifacts of at least one, if not multiple, of these points for each fucking post that we look at. I literally guarantee it. And for those that don't know, I really avoid hyperbole. So, whoa, that's actually kind of cool. How to make that? Look at that. That's pretty neat. I'm doing that with, that's fun. I'm not even touching the little pad. You'll see. Not knowing what you don't know, overconfidence, underconfidence. And then I would kind of bucket the last group, which is just structural gaps, fundamental gaps. And then the most important one on here by far is experience. Okay. So now let's talk about process. What are the primary issues an options trader is going to have from process? First is lack of one, which is crazy to think, by the way. The fact that the majority of instances we're about to look at together, I already know ahead of time, don't have any process is fucking crazy. It just shows how skewed the starting point is for people that try to get into options trading. The fact that the starting point for most people is going to fall into that bucket is crazy, because then it's like, how could we possibly imagine any other outcome other than fucking failure? It's nuts. So once we get past the fact that most people don't even have one to begin with, after that, we have all sorts of process gaps. So I'll bucket the process gaps into a couple broad categories. I'm literally doing this as we go. The first category I would say is like risk management. Then I would say portfolio management. Then I would say scanning. I would say strategy building. I would say management. I would say AAR or AAA if you're an alcoholic. And then, fuck, I had one more. Oh, audits. Okay. From a behavior side, I guess technically overconfidence, underconfidence, buckets over here, but I'm just going to start with disposition, effect. The next one that we will absolutely see is skill gap. I haven't come up with a name for this next one. Well, this one I have, but the next one, maybe you guys can help me name it. The next one's kind of like hopium. It's people still want to believe Santa Claus exists. So what I mean by that, it's like, it's the people that want to believe that there's fast, easy money. I guess you could call it like naivete or delusion, but I'm not really sure the correct term to encapsulate that concept, at least as it occurs in my mind. But the sentiment that I want to make sure is clear in this one specifically is where people, they want to believe that it's going to be fast, easy money. Like they don't want to hear the other side of that. They don't want to consider the reality. Lauren says rose-colored glasses. I think that's perfect. Rose-colored glasses. I love that. It's actually a really great term. I know you say it partially as a joke, but I literally think that's perfect. Great job. I think that's super, super solid. Impatience. Sensation seeking. If I were to summarize all of these up into like two parent items, first one is discipline. Next one is humble. All of these things essentially wrap up to these two. So if you want to have like two primary ways to think about the stuff that we're going to talk about, it really does boil down to those. Okay. So here's what I want to do. I'm literally now going to grab some posts, and I straight up want you to help me. I want you to help me identify which of these are likely in place. I'm grabbing a screenshot of this so that I can shrink it down. so that we can easily reference it as we go. Okay, so we have our reference over here. Let's move this over here and let's start. The reason why I want to do this here is I think you have a massive opportunity to learn from these other people. That's why I do this. And there's always the small part of my brain that genuinely hopes the person that authored whatever the thing is that we're looking at is able to get this feedback for themselves. Because even if they don't want it, I think it's useful. So let's start with this. This is first week of options. They're showing being up 13.7%. So the very first thing that I think about here is, my spidey sense is going off. There's something going on here that probably isn't right. I also think that this doesn't really make sense, like that kind of move. It's either individual position that did that or some sort of account value change, adding money, something like that. And then there's the 1 month change of 32%. These numbers aren't insane, especially for a small account. I'm just giving you like everything that I'm picking up, starting from the top, working down. So spidey sense is going off to a degree. These numbers do catch my attention, is likely indicating something is not good here. However, the numbers aren't insane. So we'll continue. Been investing for a few years, afraid of options, have an economics business degree. So here's the immediate thing I'm picking up here. Been investing for a few years, economics business degree, right? So this is somebody that immediately I argue is overvaluing their knowledge and experience. There really is no reason to even put these in here. It doesn't matter. If you have an economics and business degree, great. That's awesome. But that literally has nothing to do with this. It really doesn't. Same thing for the experience of been investing for a few years that's trying to display and really convince themselves of some level of knowledge. So the next thing that I'm starting to pick up here is this seems like somebody who believes this result is a product of their skill, which I don't think it is. But that's my perception after looking at the photo and a sentence and a half in. Let's see what else we come up with. And do my due diligence and research before investing in any stocks. Last Sunday, I randomly got ADHD, decided to research about options. Began the week, covered calls on a handful of names, closed out some of these trades, feeling excited for what's to come. I expect a market crash. Obviously, I love that. Obviously, I expect a market crash in the near future, not making a habit of playing options consistently, nor making huge gambles. I'm a teacher and hate my life, so hoping to make solid gains, switch careers after this school year. So, I mean, if we are to look at, again, the example that we've built for ourselves here in terms of varying effects that seem to be at play, like, what do we think is going on here? There's a million things that stick out to me. The first thing is, it's very clear this person doesn't know what they don't know yet. It's very clear that they do suffer from overconfidence. Even the fact that they say this is massive overconfidence. To sit here and say that, obviously, I expect a market crash. The fuck does that mean? Right? Like, okay, Nostradamus. Like, what does that mean? So the fact that they feel like it's obvious and that they can read the future and detect a market crash is fucking wild. There's obviously some massive process gaps in what they're doing, because the problem is they randomly decided to start researching at midnight, and then they're starting to throw some options trades out there, and this is what, again, the result that they think that they've developed for themselves. So if, again, I were to use this as an example for myself, if I was essentially making this stream for myself and I was using this as a practical exercise in things to take away and to be thoughtful about in our own process. The first thing is to make sure that you are not overvaluing your own experience and education, which really wraps up into experience. The problem with including these is that it tells us that we feel like we should be somewhat owed to some degree. And it's just not true. That's the reality of what we see here. This is overconfidence. The next thing is there is absolutely no actual process here. This is complete randomness. The fact that they decide to research is awesome. That's great. But deciding to run covered calls on these names and long calls on these names, that's not a process. Those are just random positions. So whether we win or lose on these realistically doesn't matter. It literally doesn't matter. It's a fucking coin flip. There's nothing that you are going to gain in terms of feeding back into your broader process as a trader from doing things this way. So the next thing I would be telling myself is there's absolutely nothing wrong with this. There's absolutely nothing wrong with this. But this can't be it. So the idea that we decide to put on some tester positions, maybe minimum viable size, and we want to see how it goes, that's awesome. Do that. That's fine. That's completely okay. As long as it fits within the broader risk management that you have for yourself, great. The issue is there's no discussion here about market effects. There's no discussion here about profit mechanisms. There's no discussion here about actual strategies. So these effectively become some sort of random sample. Doesn't tell us anything, unfortunately. The problem is this person is literally being fooled by randomness right now, live. Because they think of these things, they see that the happenstance of their near-term results, and they believe that this isn't random. They believe that this is due to some sort of superior approach. And again, it literally couldn't be further from the truth. Okay. So, as you guys know, this is absolutely not to bash on this person. It's the last thing I want to do. My main goal in doing all of this is to try and empower people to figure out how to do this successfully, because it can be done. I've done it. But you can't figure out how to do this successfully if this is the approach. This is not going to cut it. I also guarantee that. I guarantee you that if we were able to follow along this person for the next 10 years, if this doesn't change, they're not going to be doing this. It's not going to happen. So it really does come from a place of trying to help people improve their process and to figure out a way to actually do this sustainably, because it can be done. It's just difficult to do. Okay. Next one. What do you think about this? I'm a teacher. They're unhappy. They're dissatisfied with being a teacher. They hope to make solid gains to switch careers after this school year. What do you make of that? What do you guys think? A couple things stick out to me in a really big way here. The first thing is, as soon as desperation becomes part of the equation, I've never heard or seen of a successful outcome in that context. I've not seen it. That's not to say it's never happened. I've just not seen it. So that tells us exactly, Lauren is exactly on it. Desperation leads to making poor decisions and making mistakes. And it's because when you're desperate, your brain forgoes logical red flags, warning signs. It literally is willingly forgoes those because it thinks there might be a chance in hell, a small gap that this might actually work the way that we want. That causes a whole slew of cognitive issues when we're in the process of trying to build an approach. So let's summarize from here the trading mistakes that we can see going on. We know that this person is overconfident. We know that they're on a compressed timeline. We know that there's desperation. These are all mistakes that I'm listing. We know that they do not have an underlying process here literally at all. It does seem like they are willing to do work, which is good. But my guess is there's probably a big gap between the work that actually has to be done and then the work that they're willing to do. My guess is that they think they'll be able to do this on like a medium amount of work or like a moderate amount of work. Very unlikely. This is literally the first post we clicked into, which is kind of crazy. Ambient says, quitting your job after one profit is wild. Poor lad. To be clear, they are saying that they want to switch after the school year. So it does seem like they're giving themselves a little bit of a runway, but I mean, to the broader point, it's nowhere near enough. I've already talked about a lot of the realities of trading, right? And the really cool part about trading is you can learn most of these structural and fundamental elements of trading. You can crash learn that. You can learn that fast. That I'm very, very comfortable saying. Like that absolutely can be done fast. The problem is that there's a lot more to the process of trading after that. This is table stakes. You have to know how things work and behave in order to be able to even play. But there's no edge in that. It's literally the starting point. A great example for this is if I take a look, they said that they traded long calls on Lessel and Yeti. I have absolutely no idea. Okay, hold on, let me see. I'm trying to see. One strategy for Lessel is already in the money. So this is just obviously not understanding options. That doesn't matter. I have no idea what expiration that they're doing. My guess here is that they are so grossly overpaying for options. Let's take a look at one of these. Let's take a look at Yeti, just for the sake of an example. My guess is that they are drastically overpaying, which again, this individual trade might have worked out, but I will remind you, we don't care about the outcome of individual trades. If you are a successful or trying to be a more successful options trader, the outcome of individual trades literally does not really matter that much. It just doesn't. So let's take a quick look at good old, let me get rid of this one. Let's take a look at good old Yeti. Out of curiosity. So one of the funny things is it looks like they're selling just as the most interesting buying behavior is entering the equation. That in and of itself is quite funny. This looks like a spread. And let's take a look at vol. I have no idea what expiration they would have chose. My guess is it's definitely not outside of 60 days. My guess is somewhere in here. So let's see. They essentially paid the most you can for the vol across this entire thing. What I can guarantee you is that if you systemically do this, it's not going to work. The reason why this is not going to work is because your capability to make profit when your top ticking vol is really, really constrained. That's not to say that you can't. You can. But in the context that you do make a profit in those instances, you are making it in spite of your selection, not because of your selection. So kind of knew that that was coming. Reese says, when they said already in the money, I had a feeling it wasn't very nuanced. Yeah, my guess is some sort of near-term option that was bought out of the money. My guess is they also probably think that it needs to be in the money for it to show a profit, like those very, very basic issues. Let's take a look at one more. And then I want to talk about building kind of like a framework for you to be able to do this for yourself on your own work. So let's go back and let's find one more. Perfect. This one looks perfect. Exact strategy to start with 5K and grow the account. Experienced option seller here. Again, this tells me a lot. The fact that somebody would label themselves an experienced option seller is, again, ridiculous. Anybody that does this at a professional level, all of us consider ourselves traders. Not even options traders, traders. We essentially equate the different tools that we use, right? So like a trader that trades options or a trader that trades whatever. But again, like this in and of itself is already very, very telling to me. Lauren says experience with 5K. No, I wouldn't read it that way. I actually think what they're saying is that they're making this as a suggestion for a small account. So I actually don't hate that. My go-to strategies are cash secured puts, covered calls, bull put, bear call spreads, and strangles. IC is not my favorite strategy. Again, I can immediately detect just by this language that this is not an experienced trader, or this is the case where they think they're way more experienced than they are, literally just by the language. I keep it simple. 60% of my portfolio is in futures options. Again, that also to me reeks of inexperience. A lot of times here, people think futures options sound more advanced, more experience level than people that are trading equity options. But the reality is future options are notoriously illiquid, even in really liquid underlyings. So the overwhelming majority of us that trade derivatives in any capacity, even options on futures, which I do trade, by the way, but it's a small subset. There's no world where 60% of my book is going to sit in futures options. Either you have a very small book where this can make sense and you don't have to put on that much size, or you don't understand what you don't understand. And they're not paying enough attention to the slippage that they are inevitably paying to play in this space. Let me show you an example. Let's take a look at E-minis. E-minis are arguably the most liquid futures market that you're going to come across. Again, you could talk about bonds and stuff like that, but let's take a look at a standard expiration. Let's take a look at a standard expiration options on futures term. What's the first thing we notice here? The very first thing I notice here, beyond the bid-ask spreads being absolutely massive, is I also notice really, really low open interest. Like really low open interest, right? 3,700. 2,400, 2,243, really low OI. Let's take a look at SPX by comparison, and let's take a look at the same term expiration. This will be 21 days. This will be 20 days. Let's just take a look at the OI. 2,000, 6,000, 1,000, 1,000, 27,000, 7,900, 2,500. This is all on the put side. On the call side, I see 3,000, 3,000, 1,500, 31,000, 3,000, 6,000, 1,000, 1,700, 11,000, right? Like, just, you can hear the words I'm saying. The liquidity disparity between these is fucking massive. So this is ridiculous to assert. But the reason why they assert that is because they think it makes them sound more advanced than they are. Today, I'm writing about what I would do if I was a complete beginner starting with 5K and how I would grow it to 10. Okay. Paper trade 3 to 4 months. Okay, I dig it. 5K account, you don't have the luxury of swinging for the fences. You're not here to double your money in a month. Okay, this is good. Here to stay alive, learn discipline, stack small, repeatable wins, forget YOLO weeklies, earnings plays, 0 DTE scalps. Number one goal is survival. So this, I think a couple other things. The first thing is, like, these two are fine, but it literally misses the heart and soul of what a small account is meant to do. A small account is not meant to just stay alive and try to learn discipline. And it's definitely not worrying about stacking small, repeatable wins. This is a disease here. This is a mental disease that options sellers very often have. So it does not surprise me at all to see this here. However, the issue here is that this person, I guarantee you, if you had a conversation about expected return, they wouldn't understand it, or they wouldn't know about it. And again, this isn't to shit on them. This is just the nature of the business. Most people don't know what the fuck they're doing. The reason why this tells me is this idea of repeatable wins. It tells me you don't understand expected return immediately. So if I were to modify this to what I actually think makes sense here, stay alive, learn discipline, that's fine. But realistically, I think it's to build experience and build a trading process. Like that's what we're doing here. Trading to stay alive is, again, it's a good point to make to try to reinforce their point on not swinging for the fences. So I really don't dislike that. But that being said, I definitely still argue that they're missing the actual objective for a trader in this scenario. The other thing is this: forget earnings plays. That's ridiculous. Again, this shows a fundamental misunderstanding of how to trade earnings, both post IV contraction, post earnings announcement drift, which is a really, really well-defined profit mechanism. This is silly, but this shows that they only understand one dimension of earnings plays, which is vol contraction. That's what they're referring to here. And again, it's way off base. Okay. Phase one, start with cash secured puts on low price tickers. With 5K, can't afford to sell on expensive stuff. Sell 2 to 3 cash secured puts on lowered price liquid stocks under $20. Okay. I don't hate this so far. I think that this is obviously super limiting, and this portfolio is going to underperform buy and hold long-term, overwhelmingly probability. So while this can make money, it is in no way optimal for this condition. Number one goal, small repeatable incomes greater than random big wins. Again, this is completely wrong. It's literally completely wrong. 3.5% is still not bad to start with. Not bad to start with. Again, do you want to... This shows me that this person has no fucking idea what they're talking about. So let's take a look at what they're suggesting here. I think I have it. Yeah, I have the little calculator over here. So they're saying 3.5% over the course of 3 weeks. Let's give them the benefit of the doubt. Let's say that they're saying it each month. What's the annual return for that? The annual return for that is 51 fucking percent. But then let's go back to this. 3.5% is still not bad to start with. That's 51 fucking percent a year. You want to talk about not bad? That's literally record breaking. Again, absolutely ridiculous. Next, when I'm assigned, I will own a stock I wanted to own. This is Goldilocks analysis. This is, again, another disease of people that sell cash secured puts. They say this kind of shit. The problem with this is it shows a complete reluctance to objectively evaluate reality. The reason why I say it's a reluctance to evaluate reality is because this makes it seem like this is just great. Like, I wanted to own these anyways. The problem is if the stock is going down, there's typically a reason why the stock is going down. For you to just preemptively assume at that point in time that you wanted to own it is absolutely ridiculous. At that point, you might not actually want to own it. It doesn't make sense. I'd only sell cash secured puts stocks on things I'm willing to hold and wheel. That's completely fine. This is completely fine. Liquid, real business, IV percentile greater than 50. This shows a complete and utter misunderstanding of volatility, without a doubt. I literally just had a great podcast today with Chris from Moon Tower, and we were literally talking about this exact thing. How traders will say shit like this, sell when vol is high, buy it when it's low. And it's literally so wrong. It's not funny. And anyways, price under 20 so I can trade 2 to 3 at once. That's fine. I don't hate that. Manage risk, deploy 60, 70%. Okay, that's fine. Monthly target is 90 to 120 bucks. Okay. Build diversified wheel positions. Allocate to credit spreads. Man. There's so much in this. Yeah, there's so much in this. This right here, cut or adjust trades when loss hit 1.5 times premium. It's completely fucking random. It's literally completely random. So this, to me, shows somebody that truly believes that they have a process and that they have something tangible, and they don't. That's just the fucking reality looking through this. EH. Hey, yo, what's up, EH? Thank you for the donation. I know very little about options mechanics despite having bought them for a couple years. In your opinion, is it dumb to play leaps and just hold for 12 months? No, it's not dumb. I don't think that's dumb. I think it depends on the underlying that you're trading. And then I think it depends on what the expected profit mechanism is. So let's get rid of this garbage. And let's say that you're interested in a stock. So EH, do you have a specific stock that you're thinking of when you're referencing this? We can talk about that one in particular. If not, I'm happy to just pick something. But yeah, if you let me know what kind of stock that you're looking at, I can give you more specific. Crypto-related miners and ETH ETFs. Yeah, so there's a new ETH ETF that's been going crazy, right? I don't know if is it the iShares? ETH A? Is that right? Yeah, because this one's been going pretty parabolic. So if we are generally bullish on ETH, and we think Ethereum is going to go up over the long run. There's absolutely nothing wrong with going far out in time and using long options as a stock replacement. The thing that you have to pay attention to in that kind of circumstance, though, is to do your absolute best to not grossly overpay for the option. One of the things a lot of new traders don't fully appreciate is how important volatility is in your trade, even if you don't fully see it. So here's an example of this. If let's take a look at ETH A, we'll literally look at a live example together. Let's say we'll compare two different trades. We need our log. I'm going to move this off to the side just so that I can capture the trades, and then I will I'll bring it back over so that you guys can see what I'm looking at. I actually realize I need to modify this log for you guys. Give me one sec. What I want to do is make sure I have a spot to actually capture like changes in vol, because I think that that is ultimately relevant for a lot of the conversations we have. So we need one there. We need one there. We need one here. And we need one here. Cool. Sweet. I'm just updating this log. I'll show you guys in a second what it is. But the reason why I want to do this is, again, I think it'll be a little bit easier for you guys to see the stuff that I'm talking about. All right. Beautiful. Oops. Cool. So all I did here was include spots for us to track vol along the other stuff. So let's just eyeball a couple things really fast. Today's date's 25 July. Keep that for both ETH A or THA. You get rid of the E. Fun fact. 2758, 2758. We'll do one lot for each. We'll compare two different expirations, 19 SEP. And then let's compare 15 Jan 27. Okay. So let's just look at the money long call to start. So that'll put us at the 29. That's 51 delta. And then instead of the IV in this case, I'm actually going to input the Vega. I want to track the Vega in this circumstance, which is 0.044. And then I'll put the IV next to it here in the short call delta, just so that we have that too, which is 61.5. Okay. So next, actually, I'll put it down here, just so that it doesn't fuck up our stuff, which I already did. Shame on me. Put it up here, 61.5. Okay. So now let's go down to this one. We'll do an at the money as well. So that puts us, the at the money in this case at the 29 is a 68 delta. The IV, or in this case, the Vega, is 0.123, satisfying number. And then the actual vol on these is 69.24. So let's talk about this from just a basic options lens. What this means is, depending on how the underlying moves, you are going to have very, very, very different experiences in your total P&L. So let's take a look at what this means. If I grab space over here and let's just make up some inputs. Let's say that we have stock price and then we have vol. Now, this isn't fully accurate because the vol would be different across these different terms and stuff like that, but I just want to show you an example of how these different things behave based on different size moves. So if we get a 1 point move in spot, we can calculate how our premium will change. Let's start with that. How do we calculate that? Actually, you guys know how to do this. We literally would just take our delta, multiply that by whatever change in spot exists, multiply that by your lot size, multiply that by 100 to get your multiplier. So that means if we get a 1 point move, this is going to change by 51 bucks. Cool, easy enough. So now let's lock that one so that we can drag it down. 68 bucks on this one. That makes complete sense because of the delta, right? Easy day. So now let's take a look at the Vega impact. So very similar to what we just did for delta. It'll be this. Normally, I'm a little anal about this. I like to do it like left from right. I know that probably surprises you guys. 100. And then let's drag this down. So now let's say vol changes by 5 points. Notice what happens here. If we can track our net change, so in this case, really we would want it to lose 5 points. And then we can sum the aggregate P&L change for these. Let me take a pause here. Actually, I realize this is a beginner stream. Thoughts here. Is everybody on the same page? Do you understand what I'm doing? Do you have any questions on what this thing is so far? I don't want to completely lose anybody. So this is your delta. This is your Vega. And then this will be your dollar delta. This will be your dollar Vega. So now, this idea of using leaps is a good one, because what does that mean for us in a comparative landscape? Well, it's really simple. If we take a look at the cost of these, it's $950, $955. So let's say that your premium here is 9.55, and it's really for this one down here. So what does this mean? Well, we can figure out what our total deltas are. Your total delta is just your current lot size times 100. And realistically, I would relabel that as like max delta. And then your current delta is simply whatever the current delta is times your lot size times 100. So in this case, your current delta is just 68 deltas. So you have a one lot. This obviously would change if you had multiple lots. So let's take a look at the comparative position size. I can zoom in. I can fix the difficult to see. So if now we look at the comparative position size out of curiosity, spot price is 27.58. So if we were to buy 100 shares, the equivalent position of shares, we would have this times this. We're going to put up $2,758. And then that's to control the max position. If we wanted to control the current position, we would need 68 at this, which is 1875. How much are we actually paying to get this? Well, it's easy. It's this times 100, $955. So you are controlling effectively the same total size position here at half the cost. So this is why that leverage can make sense. But with this leverage does come some level of complexity. So in this case, we looked at vol changing 5 points. Let's just eyeball how vol has been moving in ETH A so that we can come up with an accurate estimation for how much vol might change. So let's use the long dated options so that it's accurate. And vol here moved from 92 down to 67. And then from here, 67 up to 71. And then let's take a look at one more sample, 86 to 81. So let's say that the average move that we see here is like 8 points-ish. So if vol drops 8 points and the stock goes up by $1, take a look at what happens to your option. It's this one here. Let me get rid of this. Your net dollar delta vega is negative $30.40. So what this means is the reason why vol is such an important component to this relationship is if you do not account for the P&L potential from vol, then you do stand to find yourself in that really annoying circumstance where you might be correct in terms of spot price change, but then lose on Vega, lose on vol, which happens to people literally all the time because it's so easy to not know to look at this. Super, super easy. Now let's take a look at IV percentile right now. It's 3.4 for long-term options, which is actually a great time to buy vol. It means relatively stuff is super, super, super cheap at the moment, which is great. So to summarize all of that, and EH, to wrap up everything that we just talked about for your question, it's not dumb at all to buy leaps. One other small annoying admin note is that it's leaps this way. It's not leaps like this. It's because the S is actually part of the acronym that stands for security. It's long-term equity anticipation security. That's what the S is. It's not making it multiple or plural. Now, as long as the trader understands this relationship that we're stepping into, then I realistically don't think there's anything wrong with using leaps as a stock replacement. It's actually exactly what I do, except I optimize what I do a little bit more than this. And I typically trade ratio call diagonals or ratio put diagonals. So what that does is it includes a short leg that's closer in time, and it's actually to help me offset my theta. So let's add theta now, and I want to actually add theta here. So this will be dollar theta, and then this will be dollar Greeks. I'm just going to sum them all. So this plus this plus this. So now what I need to do is I need to include a time input. Good old TIT or DIT, days in trade. This will be our time input. We need to grab theta for these. Theta on these is negative 0.009. And our dollar theta is our theta times lot size times days in trade times 100. That's our dollar theta. So in this case, if we're in the trade for 1 day, we expect to lose 90 cents. So now as we complete this ensemble, let's say that we actually hold this trade for a month. You'll notice that your theta starts to creep up as a ratio of your premium, meaning of the total value of your option. So we now understand, I'm going to get rid of this, that options provide leverage, which is great. But that leverage does come at a cost. It's not free. So there's ways that we can manage that cost. And that's why typically I like to use what I refer to as ratio diagonals. So what that would mean is, let's say we have a 5 lot here instead. You can see all your Greeks automatically change. By the way, if you're not doing this with me, I actually think you're missing a pretty good learning opportunity to like just whip up these random calculators that we make together. But in this case, if I have a 5 lot and I hold the trade for 30 days, my dollar theta is I'm going to lose $135 total, and I can figure out what component of the premium that's going to be, but that's pretty significant, right? Because if I take a look at equals this divided by 100, I want to put it back down relative to the premium as this. So I'm essentially losing 14% of my premium after holding this for like 30 days, just on the theta component. So I can offset this. What I can do is I actually think we have a calculator for this that we built somewhere. Hold on. Listen, I know that we have a couple fucking calculators around. Here we go. This is the one that we built. Look at us go. Fuck yeah. So let's say we have a 5 lot, and this one is the 29 strike. We are at 539 DTE. Premium was what, 955? I'm in the wrong spot because I'm an idiot. Theta was negative 0.009. Days in trade we're simulating is 30. So what I can do is I can figure out how many short options I might need near term to offset some of this. So these are terribly illiquid, can't do anything there. This one we could do. So let's take a look at something like a 30 delta, maybe these. So 33 delta. That 33 delta puts us at the 33 strike. That's kind of fun. The premium we're going to get at the 33, I'm just going to call it like $1.42. And my theta on these is 0.025. So what I can do is I can figure out, hey, how many of these in the front do I need to sell in order to offset the number of contracts that I'm carrying here for this set duration? So the cool part is we can literally just do a little bit of math and figure out what we might want to sell. So let's essentially do that together really quick. We know that we are going to lose essentially 90 cents for this trade. I think, let's go back to a one lot. Really, we would need more than one lot though, so that's a lie. We're going to lose, hold on, I think, no, this is okay. So on these, you can make, again, about $1.42, and you're going to get 20 or 2.0.025 per day in terms of theta. So 0.025. So if I look at this as a ratio between these, I can figure out how many contracts go into the theta that's provided here. So what this is showing you is one of these, in terms of one of these short calls, in terms of the theta that it gives me on a daily basis, it covers 2.7 of these. So what that means is at the end of a day, if I have 2.7, you'd have to do 3, you'd have to round up. If I do 3 of these, I'm literally going to have a net positive theta at the end of that day. So let's take a look at this in an example really fast. And then I will kind of sum up the lessons that we've learned so far. So in this case, this is going to be a call. So this is a 29 call, and that's a long call. This one will be, what did I say, a 33? And this one is going to be short. So we'll denote that by the delta. And that was like a 0.33 delta. And then all of these, I'm pretty sure, are calculated, except this one. Vega on these doesn't really matter. We'll throw it in anyways, though, which is 0.040. You'll notice that I'm adjusting the Greeks to be relevant to the position, whether we bought or sold. So we're short the deltas, we're short Vega, we're going to be long theta, which is 0.025. And then we're going to be, I guess really this one would be a negative premium technically, but doesn't really matter. And these we're going to get, we said like $1.41, $1.42. So let's see what happens. Let's double check if this is good. That's a spot change. That's good. Vega, theta, we need to lock AM. This one. And then Vega, we also have to lock AM. That's good. Okay, cool. So here's what we've learned. By adding this short leg, what I'm doing is you can see I'm offsetting some of the Vega, not all of it. It's still going to be net painful between these two, right? So if I net these to one another, the important thing here, however, is this column. So what I'm showing you is by selling a set number of near-term short options against these long options, what I can do is essentially be net positive on my carry cost. Now, this decreases your future profit potential because you have shorts against the longs. So this is also a balance that you have to strike. You have to figure out how much of this cost you want to offset, because there's nothing that says that you can't just do 2. And in this case, you're still slightly positive. If you chose to do 1, you would be net negative, but you're still essentially cutting your holding cost in half. So there's still a net positive benefit there compared to the other scenario. So let me take a pause on all of that. Does that make sense in terms of different ways to think about using leaps in order to serve as essentially a synthetic long stock position? The important point to take away from this is that if you take a few moments to analyze options and to extract the information that they have for you, you can come up with a highly informed position that actually helps you achieve whatever the ultimate risk reward profile is that you want. Now, one really important note for these is that a lot of times people consider this short leg income of some sorts, and I would avoid that at all costs. It really isn't income. In this case, all we're trying to do is offset our holding costs so that we still have this convexity from the long calls, but it's subsidized from these. Cool. It looks like you all are complete experts here, which is sick. I'm glad everybody seems to be pretty comfortable. Good. Let's pivot now. Now's a perfect time. If you have any other questions or anything else that you want to take a look at, throw it in the chat. Now's the perfect time, and I'll start to summarize what we've talked about so far. Lauren says, do you always have a leg with a leap? You mean a short leg against the long leg? Because I mean, if I were to answer that technically, it would be yes, right? Anytime that you have a long option, technically you have a leg. The way that we refer to legs in options trading is just the individual strike that you're looking at. And Lauren says, do you always have essentially a short option with when trading leaps? Always, I wouldn't say always. Really, those kinds of like definitive, all-encompassing statements essentially never reflect true in my trading. Now, to get to the practical component of the question, I would absolutely say the majority of the time I have short legs against the longs to subsidize the cost. Definitely. I definitely would not say always, though. Again, just anytime that we talk about kind of all-encompassing scenarios like that, you lose a little bit, I think. And it's literally for this. Now, the instances that I wouldn't are where I'm just super, super, super bullish on the thing that I'm trading. And more often than not, if that's the case, I actually would just run a synthetic long versus a ratio diagonal. Ratio diagonal is designed to hedge your bets a little bit. Whereas this kind of thing, if I just run a synthetic long, this is a way more pure play with leverage on this thing. So again, this isn't a pass-through IRA, so it requires it to cash secure, so it's no different, essentially cash requirement than if you were to buy. But it's a little bit different than in a margin account where your margin requirement would be much lower. But this is really the better way, I would argue, to achieve the synthetic long position if you just want to be long for leverage. This is just straight synthetic stock. This also does help subsidize the theta, but this typically won't subsidize it as effectively. So if we take a look at the theta on these, you would gain 0.007. And that's because there's a little bit of intrinsic value on some of these once you get to being in the money. So these are at, again, negative, it would be positive in your account if you sold it, which is 0.007. And then again, these are still, you would be losing 0.009. So net would be negative 0.002. So it doesn't handle the time component as neatly as this. And it definitely has more downside risk because again, you're just synthetic long the underlying. But that is absolutely another way to think about this kind of thing for sure. So let's zoom back out and let's talk really quick about some of the main concepts that you learned today. And I want you specifically to think of this in the context of how this might fit into your own process. When you look at the process of trading, you all already have a pretty good sense of, at least my opinion, on what's required. Boils down to learning and having some sort of back end process in order to feed into what you're doing in an iterative way. There's no world in trading where in the beginning, you're just going to get it right from the jump. You have to position yourself to be able to learn from your process in order to make adjustments and ultimately become successful. So in the first part of our little mini series here, these are absolutely the most common trading mistakes that, if not accounted for, lead to bad process, bad behavior, and ultimately would lead to losing money, either quickly or slowly, but nonetheless losing money. So the next episode, we'll spend a little more time talking about how to fix these. And most of you will already have a pretty good sense of how to do that, but I always think it's worth talking about. So that stuff aside, let's just bullshit. Let's just talk for a little bit. I actually got to get my dinner order ready, but I want to know what's top of mind for you guys. So for those that are in your trading, like you're learning to trade or you've been trading for a little while, what are the things that you are working on? Are there any roadblocks that you have that we can help take a look at? This is a big thing that we spend time doing in like the Outlier Pro Plus workshops, because sometimes it doesn't really take a whole lot in order to unlock the next piece that you're trying to add to the broader puzzle. Daily Street Fights, what's happening? That's fun. Says, how long would you say it took to learn code language for backtesting? Ooh, good question. Probably like 18 months. Like I definitely was enough. I definitely had enough fluency to use at least basic concepts earlier, but I'm thinking of it more so from the context of like, when did I have the process built out and the infrastructure built out how I wanted it? And I think that's a pretty fair estimate. I never tracked it, so I don't know specifically, but I would guess I'm just picking the midpoint between 1 to 2 years. I think somewhere around there is probably fair. Matthew up above says, if you're long on a stock after doing your research, have high conviction, is leaps a viable strategy? Would you prefer covered strangle or buy and hold? Oh, that's funny. We were literally just talking about leaps for a bit. This depends on how much you think it's going to go up. It's a great question. And this gets to the heart and soul, though, of understanding profit mechanisms. So if we think about profit mechanisms, let's say ETH A, we'll literally use this as an example because we're here and it's a great example. Let's just take a look at some different scenarios. Let's say that I'm long these. Get rid of this other one. Actually, that's a lie. We should keep the synthetic long. We'll do these. Let's say that we're long 100 shares. let's compare all that against being long. Let's do, how are these? These are fine. Let's do these. Let's do these at the 38. And the other one was like $900. So you'll be able to do what, like 7 of these? Something like that to be similar price. So let's just see what happens in terms of P&L. I'm doing my best to normalize by price to keep them about the same. So actually, in order to do that, we have to normalize off of stock price because that's going to be the most expensive one. So that would be, what is this? 990, like 3, a little less. We'll just call it 2. And then these are $1.88. And these need to get to 28, so like 24-ish. So let's see how these behave. If we have, let's start with the stock because that's the simplest, I think, for people. So I'm going to just track the P&L here so that it's easier for you to see. We'll do plus 15%, 10%, 5%, spot, -5%, -10%, -15%. And then we'll have a handful of scenarios. We'll have the stock comparison. We'll have the synthetic long. We will have the, what is it, like 130 DTE calls. Then we'll have the leaps. So these are the different scenarios that we're going to compare. Cool. So let's start with the stock position. I'm going to move this out of the way. I will bring it back once we get to this point. And let's just grab our P&L. So we have 422, 281, 140. I'm just going to call the other one flat. Minus 142, minus 283, minus 424. Now, all of these I'm also going to have to put in relative terms of cost. If we wanted to do like a real apples to apples comparison, I don't think it matters that much. So I'm not going to bother, but just so that you're aware. So now let's take a look at the synthetic long here. So we're at 424, 282, 141, minus 142, 283 to the downside, 424. So what do you notice about that? Sounds real familiar to what we just looked at, eh? The next one, we need 2,800 of these, 1.88. So 188 times, what is this, 24? So that's way too many. So we need 2820 divided by 188. We can get 15. Okay, 15. So these will be 2337, 1454, 662, negative 645, negative 1162, negative 1594. And then the last one is our leaps, which we can get essentially 2 of those. That puts us at 529, 324, 124. Down 5 is negative 258, minus 440, and then minus 615. So what we can do is literally directly compare the effective P&L of this system, comparing these different strategies. So let's see. Yeah, that's what we want. I like this one better. So what do we notice? Well, we should naturally see that this stands to make and lose the most. And it's because we have much more exposure in this position. The 130, whatever the DTE is about there, the call position, we have 15 of those. So our total deltas are way, way different than the total deltas here, here, and here, right? So if we were to talk about the total deltas of stock, this is 100. This will be just about 100. This, what did we have? 15. So this would be 1,500 total. And then the leaps, we have 200 total. So your position here is just overall much bigger. Now, the other thing I want you to pay attention to is this move. Notice how in this smaller move at the 5 handle, so 5% up move, notice how the leaps actually underperform the stock and the synthetic long. This is because it takes a little while for the deltas to come online. You need a big enough move in order for these deltas to make sense. So what I mean by that is the deltas here, they start at whatever it was, a 60 delta. So as the stock moves up 1 point, you're going to get $60. Whereas these are getting that $100. So what that tells us is that there's a point where your deltas fully do come online and start to overwhelm the P&L of these. And it's because you have 2 of these compared to 1 of these in terms of total deltas, 200 deltas versus 100 deltas. So an important element to understanding what's going on here. So the summary for that for Matthew is there's a lot of different ways you can use options to trade that position. And a great way to start the comparison is literally to analyze the behavior and to see what makes the most sense for what you think is going to happen based on your hypothesis. So it's a really good question. And I hope that this helps gives you a little more context. Daly says, what code language would you recommend to learn? I assume you mean for back testing, and I think Python is sufficient. So I think the main thing is you'll also have to figure out your data source, how you want to do that. A lot of times, like I would use SQL for that, and that is kind of its own thing on top of it. So you kind of need both. But if you're doing some sort of API integration, then you don't really have to worry about that. You can just learn enough Python in order to be dangerous. And the cool part about that is you really don't even have to learn it anymore. You could just literally use ChatGPT or something like that to help you build out the entire process. The other thing to keep in mind is you can back test really efficiently using something like on demand, right? We do that all the time. And we actually did a recent example of that during one of the pro streams because we were comparing different types of earnings plays, right? To give us some ideas on how do these different earnings plays behave based on different shocks to the system. Because that's a really important thing that traders have to be aware of when you're trading really anything is the impact of shocks. And a lot of times I think that goes broadly underrepresented, I think. Although it should be way, way, way more important to people, but they tend not to think of it. So the next session that we do together, which will be next Friday, my plan is to discuss some of what we've learned. I think I threw the screenshot. I don't remember where the screenshot is. Maybe on this one. Yeah. I want to talk about actually building something to address these, especially as a new or just growing options trader. This is more important than you think if you intend to trade long term, because again, like, this is a great example of somebody who thinks they know something and they genuinely only have small pieces of this thing. And it's that effect that's so confusing and can really send people down a bad path of losing a lot of money. And this is no shade to this person. This is really, really common. Just about everybody goes through this. Mark says, you ever trade nat gas futures to allocate away from leverage ETFs, especially at market highs? I completely decouple those. So a decision to trade nat gas futures has absolutely nothing to do with wanting to allocate away from leveraged ETFs at all. So have I traded nat gas? Absolutely. I trade a lot of the commodities, and it's because they offer very specific risk reward profiles that can be really lucrative. There's also a lot of very interesting nuances to stuff like nat gas, which has essentially a floor priced in, because at a certain point it becomes really inelastic. And it's also a viable alternative for other fuel sources like coal, where if nat gas gets cheap enough, people will literally stop burning coal and switch to nat gas. So all of those effects are very tradable. So I absolutely trade nat gas, but it's from those profit mechanisms and the lens of those profit mechanisms. It is in no way because we're near highs and I want to get out of a leveraged ETF. That completely different things. The other thing to always remind yourself, because this also, a lot of people skip over this detail, is the fact that the market is going to spend the majority of its time within striking distance of all-time highs. So what that means is if you're uncomfortable trading something that's near all-time highs, you are going to sit out a lot of the time, or you're going to be downsizing a lot of the time, when in reality, you really shouldn't be, because you're just missing really good opportunities. And I think, again, that catches a lot of people because they get nervous about being near all-time highs. The market spends most of its time there. So you kind of have to bake that into your broader approach and how you're really trying to position yourself, because otherwise you will fall into that category of people that literally just sits on the sidelines, and then you're kind of wondering like, well, what the fuck's happening here? Why am I not making the money that I thought I otherwise should be making? So yeah, that's my sales pitch on all-time highs. People get shaken out way too frequently, I believe, from all-time highs. And I absolutely believe that it normally comes from just not understanding, again, markets well enough. Yeah. Billy's Eggplant. What's up, chap? Pip, pip, cheerio. Do you feel excited about GME, GameStop, for those wondering, achieving good old bone cone? Negative. Right now, it looks very flat to me. Just kind of consolidating, trending sideways. Vol is starting to build a little tiny bit, and it's just because it's spending so much time at these levels. So from that lens, seeing a little bit of vol come in is good. But yeah, otherwise, it really is just kind of being super mellow here So the range bound trading continues as far as I can see. Fair question, though. It is kind of interesting to see, like, eventually when it does break out of this. I'm actually very, very interested in that myself. Reese says, thank you for educating about market makers and the function. It's like no retail traders know what they do, and now I can't go back, and it drives me crazy. The funny thing is the majority of retail traders really have just such a small snippet of how the markets work. And the majority of them really do not invest the time or effort into functionally learning the markets. And that's broadly because a lot of them will, again, they still think that there's going to be some sort of fast, easy money. And again, you're just not going to find it in trading. And that, I still argue, is a really, really good thing. The fact that that is the case is why there is such an opportunity for the people that are willing to put in the effort to learn this shit. So I'm very passionate about that topic for that exact reason. Lauren says, made 2K in penny stock this week. Now understand why people get addicted. Don't yell at me. I know it was an accident. 15% skill, 85% accident. Well, I think the broader thing, honestly, for you, Lauren, that I would take issue with is just that's, to me, still shows that there's a little too much focus on the outcome of individual instances, right? Because otherwise, there's not a great compelling reason to trade penny stocks unless, you know, we think that we might be able to make a few bucks on some sort of explosive move. Unless you have a system. If you have a system built around penny stocks, I wouldn't hate it, but there would need to be like a defined system behind it. And again, that becomes really difficult with something like penny stocks because of how skew prone they are. So yeah, I don't inherently hate that, but it's the underlying assumptions that there's probably not like a well-researched underlying profit mechanism and then strategy built around that profit mechanism that I wouldn't like. Lauren says, I want to see how deltas move and thought it was going to go up at least $1. The fuck does that mean? You know how deltas move. What do you mean? You literally know exactly how deltas move. And you also know how delta changes based on gamma. You 100% know this. I don't buy that for a fucking instant. Also, I don't buy it because if you just wanted to see how deltas move, why would you put on a position that you'd make 2K? Because that means that you're not putting on a small position. You're putting on at least enough size where that move will happen. So I'm not buying it. I'm not buying this shit. Don't try to trick me. Ain't happening. Ain't no way. Awesome. All right, gang. That is my time. Super fun. Hanging out, taking a look at the markets. If you guys need anything, let me know. Tomorrow, I'm not positive if there's going to be a stream. I'm planning on it, but unsure. Then Sunday, we will have the Outlier Pro market prep. And then we don't have a workshop technically scheduled for Monday, but I might slot one in anyways, just for kind of like a working session. So that's the move there. Matthew says, thank you. You should do merch. I'd buy a shirt. I did for a little while, really just because I wanted something with my own brand on it. The problem is the shirts that I like, really, there's not a reasonable way to get them to you guys, even at cost, not even like making any money off of it. it's just because like I like the Nike Dry Fit shirt, and they do branded Nike Dry Fit shirts. So those are the ones that I have for myself, but they're just, you can't get it at an economically viable price for like a fucking t-shirt. It's ridiculous. So yeah, no, I appreciate it. Thank you, Matthew, for the gesture. Eventually, if I find something that can do it at like a reasonable cost, I definitely would, just because I think it's fun and it's kind of cool for everybody to be able to have something like that. But yeah, I don't like doing stuff half-ass, and I can't find like what I would consider to be good shirts that are at an economical price. So if that happens, I will let you guys know. Be an outlier. See y'all later.